This will be the last video for chapter number 5. This is part 5, and that's going to be on the category of charitable contributions here on Schedule A. Now, the rules for deducting charitable contributions has drastically changed for the year 2020. We're mostly studying 2019, but let me point out a major change for 2020. If we take a look at the 1040 form, this is the 2020 version. It's still in draft version. You can take a deduction for charitable contributions without deducting itemized deductions. In other words, you can take a standard deduction, but then for the charitable contributions, you can claim it, let's see, here in line 10B. This is something new, up to maybe a maximum of $300. And again, this is a draft version of the form, so I haven't seen the so-called instructions yet for this line, but I believe the maximum here is $300. Now, if you still want to claim any excess charitable contributions over 300, you cannot report them on Schedule A. Okay, it's either going to be all on Schedule A or 300 here straight on the 1040 form. Let's take a look again at the Schedule A. So there's two broad categories of charitable contributions. One is for cash contributions or checks that you write or charges to your credit card. All of those are considered to be cash contributions. And then other things you contribute other than cash would go into the line 12. And there's different reporting requirements. If your contribution, any one contribution, is over $250, in addition to keeping track of the amount through receipts to cancel checks, you have to get back from the charity a letter, sometimes we call that an acknowledgement, saying that you, the donor, didn't get back anything in exchange for giving the money or giving your contribution. Okay, that's if any one gift is more than $250. Now, if your non-cash contributions total over $500, you have to fill out this form 8283. So let's take a look at that form. And the most common type of non-cash contributions would be stuff that you would give to Salvation Army or Goodwill or Kidney Clothes or Kidney Car, and you would have to fill out these lines here. Unless the amount for any one gift is less than 500, you don't have to fill out these three columns. So there's a lot of detail here for non-cash contributions, especially determining what's the value you're going to deduct. Most time the value is going to be less than the cost that you probably had bought that item for. Yeah, but you get to deduct the value. So how do you value the most common type of stuff that you contribute to, let's say, the Salvation Army? Well, the Salvation Army has a pretty good site giving you possibly a range of items that you can deduct. So these are different categories and you can see the range of items, yeah? Especially for clothing. Look how small it is, yeah? A lot of people try to deduct the whole original cost or even higher value than that. But you got to be conservative, yeah, when you deduct something that's already used. There's no sentimental value that's deductible here. Okay, so this is a site that's linked in our Laulima chapter resources folder, or you can Google this thrift store Salvation Army site. If you're contributing a automobile, a vehicle, you shouldn't deduct what our textbook says is the blue book value. What you should do is wait for the charity to get back to you with this form called a 1098C, and they're going to probably sell that vehicle that you had contributed. And what you can deduct is the sales price and not what you think the value of that automobile is. Yeah. So even though you make a contribution, you still got to wait and get back this form. And that's reported here in this section of the 8283 form. Now, if you make a contributions that total, non-cash contributions that total more than $5,000, you may need to have a professional appraisal done. Yeah. If any one item here is over $5,000, you probably have to have this form signed off by a professional appraiser. And of course, that's going to cost money yet to get an appraisal. So a lot of record keeping here, especially if you're making non-cash contributions. One tax planning opportunity is maybe to contribute publicly traded securities like stocks or mutual funds or exchange traded funds. And if you've held it for the year and it's increased in value, instead of selling that security and paying taxes on any gain and then contributing the money, what you can do is contribute the security. You instruct the broker to transfer the stock to a charity, and you don't have to report any gain, and you get to deduct the value of that security at the time you make that contribution, so you can save taxes here. Again, this is form 8283 when you're making contributions that's not cash. Let's go back to the Schedule A. And again, this would be the cash contributions here and the non-cash contributions here in line 12. But what you don't see on the form is that there is an income limitation. In the case of cash contributions, if you can contribute up to 60% of your adjusted gross income. If you contribute more than that, you get to carry it over for the next 5 years, subject to that same percent limitation of AGI for future years. In the case of non-cash contributions, I believe the AGI limitation is 30%. If you make both cash and non-cash contribution combination, there's another 50% AGI limitation. And what makes things even more complicated, for the year 2020, cash contributions, you can deduct up to 100% of your AGI. Again, this is for 2020, yeah? And I'm not sure if they're going to extend that to future years, but this rules here is for 2019. Really, the 60% is 2019. I think the 30 and 50% AGI limitations still apply for 2020. And again, anything that you cannot deduct because of this AGI limitation, you can carry it over for the next 5 years, subject to those same limitations for future periods. We're not going to cover this casualty and theft loss because it's not common. The reason why it's not common is because the loss has to be related to a federally declared disaster, things like hurricanes or tornadoes or tsunamis. If you have a car accident, your home burns down, that's probably not a federally declared disaster. You have to reduce any loss by insurance proceeds, and also there's a reduction for 10% of the taxpayer's AGI. And you don't necessarily get to deduct the value of what you lost. Many times it's the cost, if it's the lower of the two, that would be deductible. Again, reduced by insurance proceeds, reduced by 10% of the taxpayer's AGI. And for most times, it's going to be zero. And it has to be a federally declared disaster-related casualty. Okay, you total up all of these different categories, and here at the bottom, hopefully this is larger than your standard deduction. Again, you may be able to claim itemized on Hawaii because the standard deduction for Hawaii is lower, while the standard deduction of federal is higher. Okay, so that's the end of itemized deductions here in Chapter 5, yeah, reported on Schedule A. Make sure you read your textbook. Nothing replaces reading our book. Okay, talk to you later.